In this audiobook, we'll explore the essence of Waqar Asim's trading philosophy, how understanding the intention behind price, and not just the pattern, can turn confusion into clarity and hesitation into precision. Chapter 1: Simplified Market Structure Strategy to Win Big in 2025. Think of market structure as a living organism. It breathes, expands, contracts, and pauses, moving through three broad phases: bullish, bearish, and consolidating. Inside these phases are repeating patterns: accumulation, which often leads to bullish expansion; distribution, which precedes bearish decline; reaccumulation, a continuation of bullish strength; and redistribution, a continuation of bearish weakness. Every move the market makes is a dance between impulses, retracements, and consolidations. At a higher level, we have what's called the external structure, the main pushes that create new highs or new lows. Within each push lies the internal structure, the smaller, detailed movements that make up that big leg. When you can read both, internal and external, you begin to anticipate the market's next destination. You start seeing which levels are likely to act as extremes, the highest or lowest points of the main push, and which are decisional levels, where structure actually breaks. Inside those internal ranges lie inflection points, small but powerful areas where manipulation takes place. Traders who blindly follow structure without recognizing these zones often get trapped.
Why?
Because liquidity is the magnet. The market seeks and destroys liquidity, always. Liquidity pools appear everywhere. At Fibonacci pullbacks, especially 61.8 and 71%. At double tops and double bottoms, where support and resistance traders stack orders. At the third touch of a trend line. Around moving averages and indicators. Even among smart money traders chasing market structure reactions. All these pools overlap inside consolidation zones, and those zones become perfect hunting grounds for stop losses. The market's job is simple: induce participation, then liquidate it. That's why manipulation and inducement exist on both sides of a range, at the highs and the lows. Even smart money traders get trapped. A common example: price forms equal highs. Liquidity is swept. A bearish reaction appears. Everyone jumps in to sell, only for price to rally even higher before the real drop begins. Timing and context add another layer. Different sessions, the Asian range, Frankfurt trap, and London open, each have their own patterns of manipulation. When you align liquidity with time of day, your accuracy multiplies. Before entering a trade, you want three things: a clear inducement, liquidity taken; lower time frame confirmation, a small internal break of structure, a BOS; and favorable timing, often around the London open. A classic setup appears after a false inducement and an internal BOS that aligns with the external trend. The takeaway is simple but powerful. Trading only market structure, support and resistance, Fibonacci, or smart money concepts in isolation leads to losses. Real profitability comes from understanding intentions, liquidity, and inducements, and acting like a disciplined trader who waits for strict confirmations and clear liquidity removal before taking any position. Chapter 2: 3 Critical Mistakes to Avoid When Trading Market Structure. Most traders lose not because they can't read structure, but because they can't distinguish between a break of structure, BOS, and an inducement. In hindsight, it's easy, but in live markets, this difference decides profit or loss. Waqar Asim himself admits he struggled with this distinction until he discovered the objective differences, and that became his edge. Over 7 months, he shared 60 live trades, producing a 55% gain, all based on correctly identifying inducements combined with time-based manipulation. His conclusion: inducements fuel the market, and liquidity is the real truth behind price action. Let's go deeper. A bearish market is simply lower highs and lower lows. What looks like bullish movement inside a bearish leg is usually just a complex pullback, not a reversal. Demand zones inside a bearish market? More often than not, they're liquidity traps, not true reversals. The skill lies in knowing when a supply or demand zone is genuine and when it's being used to collect liquidity. While structure itself can be profitable, inducements reveal the weak points that would otherwise cause losses. An inducement is a liquidity grab, and that liquidity becomes the fuel for the next real move. The market moves from poi to poi, from one point of interest to another, and inducements confirm which zone will actually hold. Because the market thrives on manipulation, familiar setups, support and resistance, trend lines, break and retest, are regularly induced. Liquidity pools are built deliberately. Traders are enticed in. Then the market sweeps their stops and moves the other way. A perfect example is the accumulation schematic. The spring is inducement. Sellers exit, buyers enter. Both get trapped, and that fuel powers the next expansion. To truly see inducements, you can't rely only on higher time frames like the daily, H1, or even M15. They're too broad. Drop to the M5 or M1, where inducements, traps, and timing manipulations become visible. On these smaller charts, look for three key elements: a break of structure in the new direction, imbalances or displacement, fast, aggressive candles showing momentum, and proper timing, usually within session opens such as London. If you see what looks like inducement but without BOS, imbalance, momentum, or timing, it's not inducement, it's just a normal BOS. Here lies the big difference. A BOS means continuation. The market intends to keep going in that direction. An inducement looks like a BOS but reverses. It's a fake-out liquidity grab. For example, price prints a bearish BOS. Everyone sells. But if that move was only inducement, price will reverse sharply and rocket bullish instead. Use the three filters: lower timeframe BOS, imbalance or momentum, and timing alignment to know which is which. Inducement acts as a leading indicator because it injects liquidity. Stops are hit, new orders enter, and that energy fuels the next leg. The trader who waits, who restricts themselves to confirmed inducements, becomes the consistently profitable one. In simplest words, a BOS is a real structural shift. An inducement is a fake one that drives the market the opposite way. Chapter 3: The Underrated Scalping Strategy That Made Over $100,000 a Month. The market breathes in daily cycles, shaped by the Asian, London, and New York sessions. Each has its own rhythm, its own liquidity and manipulation. The key to mastering these cycles is understanding the Asian range, because it sets the stage for the entire day. Asia's highs and lows act as liquidity pools, but more importantly, they create narratives and traps that mislead traders before the real move begins in London or New York. Study the Asian session carefully. Its consolidations, its trend lines, its inducements, its sweeps. They reveal who's in control, buyers or sellers, and what the likely next move will be. Remember, patterns don't move markets. Liquidity and inducement do. Your goal each morning is to read the story the market is telling, spot the traps, and align your trades with session volatility and higher timeframe bias. Bottom line: start every day by analyzing the Asia range.